Hi everyone, Steve here, and let me give you a market update with the big sell-off in the equity markets yesterday. I just want to give you my opinion on where we're heading and why I think it's time to take a more cautious approach, especially for a longer-term investing environment. Remember, we could use candlesticks not only for trading, but for active investing as well. So let me show you what I'm looking at here. Now, first of all, this is the S&P, cash S&P. The two blue arrows point to a double top. And a double top, and a lot of traders and investors don't realize this, a double top is not only when you have two highs or two similar highs, but you have to have two highs and the intervening low, in this case here, is taken out. Only then is this a confirmed double top. So with the sell-off that we had on Monday, we do have confirmed a double top. And interestingly, the candlesticks here that I'll be highlighting in red is a classic evening star pattern where we have a relatively tall white candle, a small real body, and then a black real body that gets deeply into the white real body. And again, your charting service might be green and red for the real bodies. So we have a double top. Let me show you something else interesting. Now, although I'm cautious here, doesn't mean the market can't rally, but I'm going to give you details on that in a couple of minutes. Now, before I show you the next chart, let me go over a head and shoulders top. Many of you are familiar with this. It's probably one of the most familiar Western technical indicators. Remember, with candlesticks, we should use, and I certainly do, use my favorite Western indicators, as you should as well. So head and shoulders top, the market rallies. You have a rally here. Then it sells off. Then you have another rally. The second rally is higher than the first rally. Market pulls back. Then you have a third rally, which is lower than the second rally. And then it breaks under the lows that are between the two highs of the highest rally. And this is the left shoulder, head, and right shoulder. That's the terminology. And it looks like a person's head and shoulders. And the low of the head, the lows here, is called the neckline. And it doesn't have to be horizontal, it can be angled and so forth. In Japan, which had it many, many years, the earliest I saw reference to in the Japanese literature I had translated was in the 1700s. In the U.S., the head and shoulders was in the early 20th century, and they call it a three Buddha pattern. Because in Buddhist temples, you have a large Buddha and two smaller Buddhas, so that's how they got the name. But let me show you something interesting. Okay, so let's see here. So here's that chart I showed you before, and let's look at what we have. We have our three Buddha pattern, that is the head and shoulders, and it was confirmed by a break under the neckline on Monday. Now I'm doing this as of 3 o'clock on Tuesday, and so far, in theory, the neckline is holding as resistance, but nonetheless, we do have a confirmed head and shoulders top, so that is of concern. And let me show you from a longer term perspective. Now, those of you who've been following us for at least a couple of years know that I had called for a target of around 22, maybe 2300 back here, back in mid 2003. Sorry, you may have heard my dogs in the background. So as I was saying, I was calling for a target about 2300 back here, and the reason I got that is because the market essentially was, this is a monthly chart in the S&P in a box range, and I took the height of the box range and added it to when the market broke out and had a target, like I said, 22, 23, 2350 in that area. So yes, we still have more potential on the upside, but my concern is the risk is more a lateral trading environment or more of a correction. And so even if we move up maybe another 100, 200, 150 points or so, I think the risk of getting in the market now is much greater than it would be for a conservative approach of starting to scale out or lock in some profits. And another reason I'm saying that is not only because of the head and shoulders top and because we're very close to the target that I forecasted a few years ago, but back in 1987, below the crash, to the highs that we had before the prior crash in 2000. So you take the height of that rally and add it on the correction low. So the rally here from 87 to 2000 back to the low in March of 2009 were actually we have moved more than we did during the entire rally from 1987 to 2000. So these are some reasons why I'd be a little bit more defensive now. So with this in mind, be sure to check your emails tomorrow morning, Wednesday, to learn how to get for free our training program as a special bonus. And the program that you can get as a special bonus is called How to Profit and Protect in a Down Market. And while the market doesn't mean the market's going to go straight down from here, but even if it rallies, there will be days like we had on Monday where it could fall 3 or 100 or more points. And there are very easy ways to not only protect yourself in such a down market, even if it's only a day or two, but actually how to profit. And just as an alert, this training program as a bonus is only going to be valid for one day, July 1st. So if you have any questions, well, first of all, I want to thank you for joining me. And then if you have any questions, always feel free to contact Paul at candlecharts.com.